Hey everybody! In this video, we're going to be working on Workbook Exercise AP 12B in Chapter 5. And in this problem, we have some adjusting entries to record. We have a spreadsheet to complete. We have journal entries to post as well, and then we need to post those journal entries to the ledger accounts here. So kind of a lot going on in this problem. I think it's a good one to get some experience with sort of the whole, part of the process essentially. And so, yeah, let's go ahead and get started. So in this, for these journal entries and for the transactions to record, we've got a number of different adjustments that need to be posted here. So those are there. I've got them pulled up also on my second monitor, and I will be doing that so I don't have to scroll up and down quite as much. So let me scroll down to the input section. Okay, so for our first adjustment, we're going to be accruing salaries of $750 that were not paid yet. And so we're going to want to increase salaries expense. And by, we're debiting, add a debit to increase it. That leaves us with $21.50. And we don't yet have a salaries payable account. So let's go ahead and input that now. So sometimes if you didn't have, anything booked in those accounts, throughout the normal, not the adjusting process, you'll have a zero, balance or no really total there in the unadjusted trial balance, but you will have one there. So sometimes you need to add some accounts, basically, is what I'm trying to say. So that's our salaries piece. Interest expense needs to be accrued. It tells us that the amount is $70. So we know we're going to need interest payable, which is not yet in our accounts here. That's $70. And then interest expense. Excuse me. We will need interest expense as well. That was not. Excuse me. That was not in our accounts yet at all. So that's the debit portion and the credit portion. The next thing, we're going to need to book depreciation expense. And it tells us that monthly depreciation on equipment was $400. So we're going to need to make the depreciation expense account, essentially. $400, carry that over. And let's see, what else do we need? Oh, and then we need to book the other side of that, accumulated depreciation. And if we add those, the 800 and the 400, we get 1,200 ending balance, adjusted balance in accumulated depreciation. Okay. Just looking real quick, make sure I didn't miss one of the other sides of the debits or credits. Okay, we look good. We've got, what else? We have account of off supply, so that 320 is still on hand. So we have to do a little math just to say if 320 is left and we're showing 680, then we need to reduce that by 360. So it was to reduce our debit balance down to the 320 that it should be per our month-end count there, basically. So then we've got 360 on the credit side. We need supplies expense. And again, we need to create that because it was not originally, that account wasn't originally used before these adjusting entries. And let's see, what is the last one? I think we have one more transaction, unearned revenue of $620 being recorded. So we want to reduce our unearned revenue account by $620. And the $1,250 credit balance minus $650, oops, sorry, $620, and make sure we put that in the debit column. That will reduce our credit balance down to $630. And let's see, oh, and then the other side of that will go to revenue, because it's now, earned revenue, not unearned revenue. So 8,700 plus 620 ends at 9,320. Okay. Okay, and that's all the adjusted totals, and then we just go through and carry over all of our non-adjusted amounts. So on and so forth. So once you carry all these amounts over, I'm not going to go through every single one, but just to give you guys some check figures, you should have 2,200 total. And then on the adjusted side, you should have 24,150 once you carry all these over and add them all up. And I'll leave that part of that to you all. Okay, and then we're going to go through and we're going to record all these entries into the journalize these adjusting transactions essentially. So our first one was our salaries payable. Whoop. So that was 750. And then here we've got account number 520, and this is account 220 for salaries payable. Accrued salaries expense. And then we've got the next one of unearned. I'm going to go unearned revenue. I'll do next. You don't have to do them in any specific order necessarily. So that was the 620. Carry that over. Service revenue is account number 400. Okay, and so I'm going to leave the rest of those for you all to complete. So, that's essentially what we're doing here. The 620, it's unearned revenue, debit 620, service revenue, credit 620. So same thing we're doing down here. We're just basically doing this in journal entry format. So it's got the date, the account numbers, the explanation, but you can, like I said, I'll leave that up to you, and you can get all those amounts and accounts that were affected up here with these, and then you've got the account numbers here in the chart of accounts. So I will leave that to you. And then for a few of these, I'll walk you through. So what we want to do here is we want to go through, and one thing that's a little wonky that they screwed this up when AME on the software here. You can't put the account or the account number in this version. So this is office supplies is what we have here. This is just basically what we want to do here is to just book all of just record the adjusting entries. So the opening balance, for example, for office supplies is going to be 680. It's a debit balance. And then we're just booking the adjusting entry. And so what we had on that adjusting entry there for office supplies was a reduction, right? We credited that for 360. That left us with 320. And that was a debit balance. Okay. And then, so on and so forth. So basically it's kind of just going down the line of office supplies, and I'll do one more with you guys, and I'll leave the rest for you all. So accumulated depreciation, you'll have an opening balance, if you will, of $800, and then we're going to increase that by 400. And again, I can't put the names and the account number in here, but I'm just going down the line and just any accounts that are adjusted. So it'll be office supplies, accumulated depreciation, then unearned revenue, then service revenue, then salaries expense, salaries payable, interest expense. So all these accounts that have the adjustments in here, those are all the ones that you're going to be putting into the general ledger essentially. So I'll do one more with you, and then I'll leave the rest of them up to you. And so this one, again, as we work down the line, is the second account down that has adjustments, and that's accumulated depreciation. So it's a credit of 400, starting balance of 800, and accumulated depreciation as a credit balance. And then we are crediting to increase that balance as we record our depreciation up to 1,200. to end. You can kind of see that, here, 800 start, 400 credit, ends up at 1200. Same kind of deal. Here's what we're showing. I'll do one more with you just for the heck of it. Okay, so we did office supplies, accumulated depreciation. So the next one we want to do is unearned revenue. So again, when you guys are doing this by hand, if you do it, just write, in unearned revenue up there in the account name spot. I can't do it in the inputs here because it's glitchy. The beginning balance and unearned revenue, it was 1,250. So you can see that there. It's a credit balance, as this is a liability account. And then what we're doing is reducing unearned revenue because we earned $620 of that. So we're it's a credit balance. We're debiting it to reduce it. And that brings our credit balance down to 630. Okay, and then from there, you just continue down the line for any accounts that have adjustments. So the next one would be service revenue, and you'd put the information in here. And if for service, or I'll do service revenue too, just because that one doesn't have an opening balance. So, or the way they're using opening balance here is a little bit different than we have seen in other chapters, where the opening balance represents the actual opening balance on January 1, for example. This opening balance, quote unquote, is really more so it should be titled the unadjusted ending balance of that account. So it's not that, again, I'll do this one more just to help this. So if we're looking at service revenue here, if we do, where's our next open one? Okay, so if this was service revenue here, no revenues and expenses are temporary accounts that never have technically don't have an opening balance as of the beginning of the month. But again, what we're talking about here when it says opening balance is really not the opening balance. It's the unadjusted balance that's ready to be adjusted when we post our entries for adjustments. So that balance is 8,700. We're going to increase it by 8,700. It's a credit balance because revenues have credit balances, and then we increase that by 620 for that unearned revenue that got recorded. Increasing that with a credit brings us to 9,320. So again, it's a little bit of a nuanced distinction, but I just wanted to point that out so you don't get maybe mistaken, especially in the next chapter. We talk about closing balances and opening balances a little bit more. So keep in mind the revenues and expenses, anything on the income statement never has an actual opening balance or as of the end of the beginning of a month. Those revenues and expenses just pertain to one specific accounting period. And when they say opening balance here, they don't really mean the opening balance as of day one of an accounting period. They really mean the unadjusted balance that we are then going to post adjustments into. So, okay, so that's how that goes. I'll leave you guys the rest of the work of going through and putting the other adjusting entries into it, but you should be able to get there with the information that we've covered so far. So thanks everybody. I'll see you in the next video. Bye.